Small cap investing is not very different from private equity investing. This is a space where we're taking liquidity risk, we're taking business risk, we're taking macro risk. Anyone who's looking at less than 1 to 2 years should not come into the small cap space at all. Yes, we believe in 3-5 year investing, but I also believe buy and hold does not work. You have to keep fine-tuning your position both on a stock and a sector. I think a good Indian small cap fund today has the potential to create those kind of massive returns like Peter Lynch's Magellan Fund, which for 12-15 years compounded at
Hello and welcome to Beyond Returns podcast by ET Money. Today we have Mr. Manish Gunwani with us. He is the head of equities at Bandhan Mutual Fund. He is also the fund manager for Bandhan Small-Cap, which has been the best performing fund over the past 3 years. In this episode, he will share his insights on investing in small caps. What are the things investors need to keep in mind before investing in this space? Folks, this is going to be a masterclass on small cap investing. Hello, Mr. Gunwani. Thank you so much for joining us.
First of all, thanks for having me.
So to start with, I want you to reflect back on our market history. What difference do you see in small cap space now and compared to, let's say, 10 or 15 years back?
I think there's a lot of difference. About 15 years or 10 years back, general quality of a small cap was much adverse versus the general quality of a small cap today. I think what has gone behind this improvement is one is what we call small cap itself has become bigger, right? Today, $1 billion, $2 billion market cap, which tends to have better systems, processes, corporate governance, versus what we used to call a small cap, which was probably $100 million market cap 10, 15 years back. So one is that, which is a kind of natural evolution. Second is a lot of these small caps, when they come to IPO, they've gone through some form of institutional shareholding, a lot of times PE investors. Now, PE investors obviously would have done a lot of work in terms of board composition, accounting practices, etc. So they tend to have much better corporate governance again. Third is, I think, the regulatory aspect that in terms of investor disclosure, in terms of protection of minority rights, there have been various steps taken over the last decade. That also, to my mind, has led to the kind of corporate governance we see in small caps being exponentially better than 10, 15 years back. And fourthly, I think market cap itself has become a bigger attraction for promoters, right? Because once you cross a certain threshold of wealth, they are looking for social recognition, or it's also a great currency because you can acquire very large companies if you have market cap behind you. So I think the recognition by the promoters themselves that this is the way to create much sustainable, larger wealth rather than, let's say, taking out money from the company in one sense, crude sense. I think that has changed a lot. So for multiple reasons, I think the average quality of, let's say, the stock beyond 250 to 750, technically beyond 250 is what is called small cap. So if we take that 500 stocks beyond 250, I would say that the average corporate governance, the quality of promoter, the focus on market cap creation is exponentially better than a decade back.
I have one question on balance sheet. So research shows that large companies in India, they have a very strong balance sheet compared to, let's say, 15, 20 years ago. Their debt level is comparatively really low. Do we see the same thing in the small cap space also?
Yeah, definitely. I think the natural evolution of an economy is that at a very basic level, there tend to be more capital intensive sectors like utilities, telecom, cement, etc., which form the bigger part of the economy. And then as the country develops, the knowledge based sectors start becoming bigger and bigger part of the index. So if you take any developed country like US or Japan or Europe, then clearly, tech, pharma, brands, those would be the bigger part of the index. Whereas for India, we're still kind of getting there. So we still have very capital intensive portions of the industry being fairly big part of the index. But clearly, we are seeing that portion come down, and pharma, internet, etc., keep going up. That I think will continue. And as a corollary to that, if you see the balance sheets which are very leveraged as a proportion of the indices today versus again 10, 20 years back, it is much, much less. So you're correct that even in the small cap space, the quality of balance sheet in terms of debt to equity ratios, EBITDA to debt, etc., is much, much better than last 10, 15 years. I think largely because the kind of industries they are coming from.
We've seen a lot of retail investors have come into the market post COVID, right? They may not have enough experience. They may not have seen market corrections. If you were to share your experience with someone new, what are the few things that you will tell them about small cap investing?
So I think it's very important to educate investors that small cap investing is not very different from private equity investing. In the sense that you can't look at 6 months, 12 months return and form a basis whether the fund has done well or not, because these are very, very illiquid stocks. One big buyer, one big seller can materially move the price, which may actually in long term have no consequence, because ultimately in the long term it will track earnings. But in the short term, with liquidity coming in, liquidity becoming tight, they move up and down a lot. So I think what I would tell investors in general, and particularly on today's base, where let's say last 3 year small cap funds have given 20-30% compounded return, which typically is a good sign that the market is not very cheap. So particularly today, we have to be very clear to investors, distributors, etc., that don't come with a 6 month, 12-month viewpoint. This is a space where we are taking risk. We are taking liquidity risk. We are taking business risk. We are taking macro risk. But yeah, if you stay for 3, 5, 7, 10 years, I think that's the thought process which they should come. And I think I'm hoping, of course, that there'll be a reward for staying that long and taking that long-term view. But that is really necessary to even evaluate small cap investing. I think anyone who's looking at less than 1 to 2 years, particularly on this base, as I said, should not come into the small cap space at all.
So that's the caution. What are the good things?
The good thing, as I said, is very good chance you will be rewarded for that risk. See, one is, even if you see globally, 90% of markets, mid and small caps have outperformed large caps, particularly in phases where the economy develops quickly. So let's say Japan from 1960 to 1990, US most of the time apart from last 20 years. So US is the one big exception in last 20 years. Although again, on a 100-year basis, you will see that mid and small cap have outperformed in US also. But if you just look at last 20 years, and I think that's because they've hit upon this ecosystem which keeps producing these giant tech companies. But if you exclude that and those few exceptions, and take a set of 50 or 100 countries for the last 20 years or 100 years, you will see that the mid and small cap space has outperformed. So first of all, it tends to produce higher return with higher risk, of course. And two is, I think it's the space where obviously the highest alpha can be created, right? We all know that the larger the space in terms of market cap, the more competitive it is becoming. Alpha is becoming much more uncertain. But clearly this is a space where a good small cap fund, to my mind, is very different from the small cap index, right? Because the small cap index typically is very fragmented, 250 stocks, 400 stocks, and the opportunity to use good research, good fund management, and create alpha is way above the possibility of that in the large cap space. It's a matter of fact. I don't like saying this because as active fund manager, you want to say that you can create massive alpha in large cap, but it's empirically it's not proven that, right? I mean, if you take last 5-10 years, the kind of alpha small cap funds have created is very different. So I think when you look at those classic funds like Peter Lynch's Magellan Fund, which for 12-15 years compounded at 25-30%. I think a good Indian small cap fund today has the potential to, if managed well, hopefully create those kind of massive returns. It's not a guarantee, of course, but I do think that the space is very ripe. I also think that what is happening in the small cap space is basically that in most mature economies, there is a very, very big private equity or a private funding which is available to entrepreneurs. In India, somehow, that is happening through the listed space rather than the unlisted space. So, India, for example, a lot of the small cap companies do QIVs of $50 million, $100 million, which typically you would never find a US listed company doing such small fundraising, even adjusted for GDP differential. So what is happening is a lot of companies are getting listed earlier, which keeps pushing up the universe more and more, and also gives opportunity to good small cap funds to create more alpha.
So, just for the benefit of the viewers, I would also like you to tell us when you say small cap, right? What's the universe that you're looking at? Because we know that generally what's considered as small cap is the Nifty small cap index, right? And if we define it separately, and I'm sure your universe is very different than theirs.
See, typically we right now cover 700 odd stocks, out of which maybe 225 would be large and mid or something around that region. So effectively, we're covering about 500 small caps, but not all of them are part of the small cap index. Some of them can be very small companies where, because of some reason, could be technology or management team, they're growing very fast. So this 500 is not exactly overlapping with either the small cap index, or it necessarily is not, let's say, Nifty 250 to 750. There might be some stocks beyond 750 also we cover. A lot of them would be in that 250 to 750 range. But our universe is more driven by where we see exciting returns, obviously, because in small cap, we are not very benchmark centric. You don't cover something just because it's part of the small cap index. You cover something if either in valuation, management, or business model, there is something exciting about that company.
So, do you have any filters? Let's say you don't go below 30,000 market cap, or any filters to shortlist that universe?
Yeah, they evolve. So, for example, we typically don't cover 2,500, 3,000 crore market cap company, anything below that, because even if we were to get 5-10% of the company on a 80,000 crore base in equities, it will not move the needle for us. But again, there's no hard and fast rule, because if there is a company, let's say at 1,500 crore market cap, but we think we'll go at 30% for next 10 years, we'll still cover it. But as a broad rule, a rule of thumb, covering anything below 2,500 crore market cap is a bit difficult. More importantly, as I said, from a bottom-up perspective, you should be excited about something in the company. Either it's a super management, or it's playing a tech trend like EVs or renewables or something, or it's a very large space where this company, which is, let's say, at 0.5% market share, can become 5% market share in 10 years, something like that, right? I mean, where you feel that by not owning this, we are missing out something. It should give you that feeling, basically.
You gave us example of Peter Lynch in our earlier discussion. But right now, if I look at the US, there are 5 to 7 companies that dominates the market. Can we see something similar happening in India also?
See, it all depends whether India can create non-linear business models or not. Now, what I call non-linear business models, typically a business model which doesn't need additional resources to grow, whether it is branches or people or capital, right? So, for example, obviously, Nvidia, Apple, Google are non-linear business models because once the IPR is there, they don't need to invest so much in capital or working capital or people for them to scale from 100 to 1,000, for example. I think India will take a long time to develop those business models. If you just see the big three or four sectors in the Nifty today, which is banking, FMCG, IT, maybe telecom or utilities or whatever. These are very, very linear business models, right? I mean, for a bank, you basically need to invest capital to grow. Your ROE, some may be at 12%, one may be at 18%, but it's not like without capital you can grow. Similarly, for FMCG, the growth rate, although they are brands, so they can obviously scale without too much of resources, but typically they're very well penetrated, very established businesses. So you can't see 30-40% growth without advertising expenditure or putting people on the ground, etc. So I think this concept of 5 to 6 companies dominating typically will happen when you become a developed country where you will have some very, very big IPR centric, IPR as in knowledge based companies which don't need resources to grow. So obviously US has these big tech giants. Even if you see Europe, I think Novo is probably the biggest or the second biggest market cap company, and that's obviously a very research driven company which has cracked this GLP-1 drugs. I think most emerging markets, honestly, you should not expect research based models or big brands, global brands to emerge until they probably cross 15,000 to 20,000 dollars per capita, which India is obviously far from that. So from China, we are seeing some business models which are very tech oriented, like Alibaba, Baidu, etc. But even their tech is very local. They've not gone global. At some point, they may or may not. But when your development stage is more in this, let's say $3,000-4,000 per capita, I don't think you should expect big technology centric companies to become part of the mainstream index. Long term, we are very bullish on that happening, which is why I think we should understand a lot of these tech names, and some of them are very small at this point of time. They're very risky. But I think the interesting part is the private equity pipeline is quite healthy. So they will list some of these, let's say, cloud software firms. They will list some of these deep tech firms at some point. So it's a space we should invest in terms of understanding it. But do I see, let's say, Nifty 50, $1 trillion company emerge from India? I think it'll take a long time.
Do you believe that traditional approach to investing, where an investor holds 50 to 70% in large cap and the rest in mid and small cap, still works?
So one is obviously has to be tied to the risk appetite of the investor and the time frame. So look, if you have a 10-year time frame, I'm okay with 50% being small and mid or 60%. But if your time frame and your liquidity is such that you are a bit risk averse or you have only 1 or 2 years time frame, then I think it's very, very risky to have anything above 20% or 25% in mid and small cap. Also, I am not uh, I'm not in favor of super static asset allocation that you do it for 10 years and forget it. I think you can fine tune. Like today, obviously, as I said, most mid and small cap funds on a last 3 year basis have given 20-30%. So you should be a bit cautious. And I'm not even talking of 5-year base, because 5-year base is COVID. So a lot of these funds have actually given 30% in 5 years, but obviously COVID base caused that return. But 3 years is not from a very low base, right? So I think your asset allocation should be a bit dynamic, may not be too dynamic, but at this point, in general, having more than 50% in mid and small cap is something, unless you have a 10-year view, then it's okay. But I would think that you should be not so much in mid and small as 60-70%.
Now, let's start with the question I think a lot of investors would be looking forward to, which is about your fund. What's the magic behind the impressive returns that Bandhan has delivered?
So, first of all, let me start with a disclaimer that, as I said, you should measure small cap funds on a 3-5 year basis. And in a way, we've been only 2.5 years into this journey since the brand change happened, and we focused on the small cap fund. So it's a bit too early to judge. But yes, obviously, it's got off to a great start. And I think there are 3 or 4 reasons which are playing a role there, and hopefully they'll sustain. One is, first of all, I think there's a question of focus and culture, right? I mean, I think small caps do need a bit of a different culture than large caps, in the sense that within your team, within your distributors, investors, I think you should try to not get disturbed by these 20-30% price movements. So within the team, for example, with analysts and fund managers, the way you converse is not to be focused on what happened last 3 months, 6 months, even if the stock went up 30% or fell 30%. Because to me, the true outcome of small cap investing in a stock is either the stock you evaluate after 3 years, or if it's before 3 years, it should have gone up 100%. Right? I mean, then you call it a success, not whether in 3 months it went up 10-15%. So I think it needs a bit of a different culture of 3-year, 4-year outlook, absolute return outlook, rather than saying, index went up 10, I went up 7. That culture doesn't work for small caps, to my mind. And it's sometimes it's a bit of a challenge, I guess, because at one level we are also doing benchmark investing, and then to do absolute return investing, there is a bit of conflict there. But yes, I think the culture and focus on small caps is important. Two is, I think, you have to invest in research for small caps, because, see, per stock you can't buy too much, right? So you have to, as I said, we cover probably about 500 small caps. I think you have to cover a wide range of small caps, because, see, small caps, you're not buying for 10-20% return. So if you cover 500, you may find only 50-100 worth buying. The more stones you turn, the higher the probability of getting a diamond, in one sense. So you need to invest in a research team, which we've done to a certain extent, but it's a journey. So we will invest more in that team to cover more and more stocks. Third is, on fund management level, touch wood, I think we've been reasonably disciplined about trying to buy stocks only when they give us a good chance of doubling money in 3 to 4 years. I think that mindset is very important. As I said, small caps are a bit more about absolute return investing than to buy what is there in the benchmark for the sake of buying it. So if you see our cash levels today, probably the highest we've had in terms of it being around 12-13%. We usually have 7-8%. And I think you just be honest to yourself and say, if I don't find stocks which look like doubling in 3 to 4 years, then you're okay keeping a bit of cash. Although I do think that there are enough opportunities in the small cap space, but you try to be a bit disciplined about this absolute return thing. And fourth, it's, I think, a bit generic about investment team, but I think you have to build a culture where people are hungry for return, and then measure and reward people who perform. So it's important to develop this, I don't know if it's the right word, but a hedge fund kind of culture, where people will hunt with hunger and then get rewarded very well if they do well. Only difference being hedge fund probably works with a 6-month time frame. We work with a 3-year time frame.
Just wanted to understand how much of the performance would you attribute to the team, the culture, the research, and how much to the small cap space itself doing really well?
See, that is not a fair question, if I may say, in the sense that we are obviously measuring alpha over small cap index, right? I mean, we're not saying that we will outperform only if small cap index is up 30, we are 40. So last 1 year, for example, we've gone through a time where broadly small cap return is negligible or maybe negative also, right? So yeah, it's important for us and a bit of satisfaction there that we not only did well in 2023 and 24, where the small cap indices were up by a significant amount, but hopefully since October 24 to let's say today, when the small cap index has broadly not done anything, we've done pretty well even then. So if you see the structure of a small cap fund, it obviously has a lot of stocks. One of the things which probably people should understand is, even though our performance has been reasonably healthy, we've not taken too much of macro risk. If you see the construction of our portfolio, it's not that we have decided, oh, rupee is going to appreciate or depreciate, so we are either in domestic cyclicals or global cyclicals, or we are too defensive that we don't have any cyclical also. So if you see our portfolio, we are there in every largish sector or segment, to the extent that if small cap has textiles, we are there. Not only just financials, IT, which are the large sectors, but if you see some of the micro sectors which are not there in large cap space, like electronic manufacturing or textiles or whatever, we're there in broadly in all of them. It's not that because see, we try not to take too much macro risk by cutting out these sector deviation, because we don't know what rupee will do. We don't know what commodities will do. We don't know what regulation will do, right? There might be a sector which is very ignored, like power 3 years back was very ignored, and because of demand or regulation, suddenly it exploded, right? So yeah, I think the important point here is that we've not outperformed only when the market is going up. We've done pretty well when market is flattish or negative, and also we're not banked on any big macro call to generate this performance. I think that is actually more than the return. Honestly, the kind of granular portfolio we have with so many stocks, I never expected that we will be top decile in this space, because a concentrated portfolio theoretically should do better than us on a 6-month or 1 year time frame, right? Obviously, over long term, we felt this portfolio will work. But yeah, that's worked on a 2-3 year time frame. A bit surprising for me, actually.
Which actually brings me to one question that I think many small cap investors will have. We are seeing small cap funds, right, adding more and more stocks. So if I look at large cap, mid cap, and small cap, I see small cap portfolios more diversified than large and mid cap. Right, some funds have even gone beyond adding 200 stocks. So a couple of questions here. One is why they do that. Is it part of risk management? Two, are we going to see this trend? So as the fund becomes bigger, are we going to see they are also diversifying more because of liquidity risk and other risk in the small cap space? So that's the question. Why do we see this?
No, definitely. Clearly, when you have a diversified portfolio, you're diversifying, like we do, a lot of macro risk. Also, these businesses are inherently more fragile, right? I mean, if a big client leaves, a CEO leaves, regulation changes, these are not as resilient as large caps. So at a stock level, these are obviously more risky businesses. But I think, see, I'm not either for concentration or against concentration. Clearly, if someone is able to 30, 40, 50 stock portfolio do a good job. And I admire some of the PMS AIs, right? Because they tend to have concentrated portfolios, and some of them have done a spectacular job on a 5 year basis. I'm not even talking of 1 or 2 year basis. I tend to have a bit of bias for diversification because the difference in MF is also that you can scale a lot, right? So I think it's okay to have concentration when the amount of money coming in as a percentage of your AUM is very limited or zero. Like if I have a closed-ended fund of let's say 1,000 crores and it's closed-ended for 5 years, then maybe 20 stock is a better approach than 150 stocks. But if you're getting money every day, I think we should be objective that when the money comes, we are putting that money in the best stock available. So a lot of times that may not be what you own, right? Because what you own typically has done well. That is why you're getting money, right? So if it's done well, again, there's no bias that a good stock which has done well may still do well. But in general, they tend to be more expensive, right? If the stock has done well, the chance that it will, like trees don't grow to the sky, right? I mean, then maybe the best risk reward stock is not what you own. So then you should be fair to the investor and buy something even if you don't own it, to my mind, right? And historically, if you see, big mistakes in mutual funds have been made because when they did well for 2 3 years, a lot of them kept buying the stocks which got them there, which they own. And then when I think a very good company can also go through a long period of underperformance, they bought at a wrong valuation, right? So if you bought a stock at 60, 70 P, which is growing at 9, 10%, there is likelihood that that stock will go through 3 5 years of underperformance. And if you see the MS which are hot keep changing every 2 3 years because of this, to my mind, that they keep buying what made them successful when the risk reward was probably not there. So we're trying to consciously avoid, as I said, we try to buy stocks where we think it should double in 3 4 years. We try to be objective about if that is a stock which we own, or if it's stock which we don't own, we'll go where the best risk reward is. That tends to build a tail, to be honest, in the portfolio because small caps, they're very volatile, right? So a stock which I don't own today, if 6 months later is 30 40% down, then it's not that I'm fixated to that view that this stock is not good. If it's down 40%, probably it's good value, right? So we're quite objective about that part.
Just one small observation, maybe you can quickly answer it in yes or no. We've seen this phenomena of adding a lot of stocks post 2020, post COVID, and that period also coincides with the fund size ballooning. So, will it be correct to assume that we are also seeing this diversification because of the size of funds?
I don't think it's only because of that, although that is one big factor, but I think it's also because honestly, predicting the macro, which leads to sector calls, which lead to concentration of portfolio, I think is becoming more and more difficult because let's face it, the markets are becoming more efficient. So if you miss out a sector which you don't own and that moves a lot, it is hurting concentrated portfolios. And like if you see this calendar year, I mean, obviously, none of us with very high confidence could have predicted that there'll be a war, which led to re-rating of defense stocks, right? So if someone didn't own defense, they got hurt. So if someone was underweight defense, they could have still managed because at least you get some uplift from whatever you own. But if you have zero, then you got hurt. And you get hurt a lot because relatively one sector does very high outperformance versus the benchmark, right? So I think that's why slowly, I guess people are saying that instead of trying to predict sector performance, which is linked to a lot of these macro or random events, better focus on trying to find the better stock within that sector or theme or style or whatever, rather than taking a very very big bets away from the sector.
I have two questions. First, are you finding it difficult to find enough pockets of value right now? And if that's the reason for large cash holding in your fund. And second, are you worried with the kind of inflows that we are seeing in the small cap funds?
Not really. I don't think the higher cash level is based on pure valuation, because if you see, if the 1 year return on many small cap stocks is negative, so it's not that the valuations today are higher than 1 year back. I think the supply of paper is just too high, and we just think that over next 3-4 months you can deploy this. See, first of all, when we say cash levels are higher, usually it's 6-7%. Today we are 12-13%. So 5-6% in a small cap fund generally doesn't lead to any big change in performance. Unlike, again, a lot of large cap fund, because here the stock performance variance is so high that the 86-87% you own, that will determine your performance there, rather than whether you were 92 invested or 88 invested. But we like to think that there are so many IPOs, QIVs, private equity selling, government selling, promoter selling. We just think that next 3-4 months, unlikely that market will shoot up in a hurry. Even though macro is very, very strong for India, we all know inflation is good, current account is good, political stability, all that is there. But we just think that, see, thoda, you also have this reversion to mean feeling. As I said, 3 year return is 30% plus. Then you want to be a bit careful. You're seeing this huge amount of supply coming. So we just think that this last 4-5%, we will just deploy over next 3-4 months as the supply plays out.
Again, a very important question which a lot of investors would want to know. What's your framework for small caps? What are the qualities that you look at when you select stocks?
So first of all, we're not wedded to a framework, right? I mean, we're not pure value, we're not pure growth, we're not pure thematic. Our ultimate objective is basically okay, let me tell you why this doubling in 3-4 years is the right framework, we think. Basically, if I take a 10-year, 15-year view of the country's stock market returns, I think we are at a base which is obviously not distressed valuation. And therefore, the large and mid cap space, to our mind, will return roughly close to nominal GDP, which we think will be 10-12% or whatever. The small cap index, as I said, generally in emerging market, that tends to outperform over the long term, probably do about 12 to 15, whatever, somewhere between that. And then if we try and buy stocks which hopefully will double in 3 to 4 years, that's typically 18 to 24% compounded return next 3 years. Now, every 10 stocks we buy will go wrong in 3-4. That's another thing about small caps, that you have to be ready to go wrong, right? You go wrong a lot. But on a blended basis, even if I go wrong on 3 and some 3 will broadly do what I expect, and 3 hopefully will do better than what we expect, it typically will end up somewhere between 15-20 is our feeling, right? Which will still beat small cap index. Now, the more the hit rate, the more we'll outperform the small cap index. But this 3 to 4 going wrong is kind of priced into our thinking. Okay. So that's broadly the framework. Now, it is true that you try to be a bit growth oriented, because the thing with playing deep value is you have to go in and come out, which is possible in large caps. Like, for example, in large caps, if you buy PSU bank at 0.6 time book, at some point a good cycle comes, you sell at 1 time book. But the thing is, you can maybe move 500 crores in, 500 crores out in that PSU bank, which is pretty large. Here, obviously, let's say you get a very, very small PSU bank at 0.5 book, you can still do the trade, But putting 500 crores and going in and coming out is a bit difficult. So because your time frames are a bit larger, you tend to be a bit growth oriented. So you want to see growth usually, but also typically what we have seen is that if there is some part of the economy which is doing badly, the small caps tend to fall more in that space versus the large caps. And if some part is doing well, the small caps trade at too stiff a valuation versus large cap. So if I put that in context today, I think the capital good small caps are still very, very expensive. The risk reward is not there. But some of the rural consumption segment, there the small caps are probably better than large cap. I'm not saying that the cycle will necessarily come. We hope it will come, but at least you're not you don't have too much downside, I think, because a lot of these consumption stocks, decent brands, they are at 1 2 3 times sales. Typically in India, even some weak brands like pharma brands also, if you see when they sell on a strategic basis, they go for 5 6 times sales. So there is a hypothesis there that if a cycle comes, this segment is cheap. The macro is obviously never giving you 100% clarity. So there'll be three factors to say cycle will come: pay commission, interest rate cuts, and all that. There'll be three factors which look a bit daunting. So, but yes, I think the risk reward is better there.
Now, just wanted to understand what are the risk management principles that you have built into the fund that gives it such a nice and good downside protection compared to rest of the funds in the category?
So the same 2 3 principles. One is, as I said, we're not taking macro risk, right? So see, till Jan Feb, the rupee was under threat, right? So if you notice, at least in the larger space, and obviously as a consequence, the smaller space as well, the dollar earner sectors like IT, pharma, they were doing relatively well. And then when the dollar started weakening from Feb or something, the domestic sector like banks, etc., have done well. But if you see, our portfolio never was too skewed to exporters or too skewed to the domestics. So it's not like we exceptionally, did well only because the sector calls were there till Feb, or we've done exceptionally well post Feb. Of course, what tends to happen is if in October to Feb, the banks kept falling, we would have bought a bit more. And now, if some of the dollar earners are falling, at some point we'll start buying them more from a bottom-up perspective. It's not that we are predicting that dollar will strengthen. In fact, our medium-term view is dollar will be weak. But as I said, the global economy stocks are falling so much now that you are at least seeing 12 to 15% free cash flow yield in some stock, which typically you will not find in a domestic stock at this point of time. So I think this whole reduction of macro risk, not to take any big sector call, not to over concentrate in a theme, is obviously giving you some protection on the downside, because when a hot theme explodes, you typically see fund suffering. And two is that discipline about a bit of absolute return thinking. So if we've not found something very exciting, we've just stayed in a bit of cash, or maybe we also bought one or two nifty stocks because we've just felt that even they can double in 3 4 years. May not be 3 years, but maybe 4 years. So we've been fairly objective about not being fixated, saying that we will always buy small cap all the time. If we see a mid or large cap, we will buy that as well. So I think it's that, hopefully, as I said, all this is too early to judge because we're just 2.5 years. But yes, hopefully we're trying to just be disciplined about this whole thing.
We are also seeing a lot of quant model for trading, right? Information is moving really fast, action is happening really quickly. Let's say if something happens in the US, it is reflected in the IT stocks in India maybe the same day or the next day. So now in this world which is moving really fast, where every information is getting priced in very quickly, how are you preparing to beat the markets in such a scenario?
Yeah, I'll say something which may sound contradictory, right? so, so the thing is, yes, we believe in 3 5 year investing, but I also believe buy and hold does not work. So what I mean to say is that you have to keep fine tuning your position both on a stock and a sector along with the macro that is happening, because as the market become efficient, you can't wait for earnings to show up, which will show with a lag, or for analysts to downgrade earnings, which will also happen with a lag. So let's say tomorrow the US 10-year yield in one day drops 25 bips, which typically is a sign that US recession is coming. Then whatever is US economy focus, or whether IT or global auto or whatever, you have to incrementally take money off the table, right? Otherwise, if you wait for the actual recession, for the downgrade and all, you will obviously be behind. So, what I think is a good approach is you have a 3 5 year view on a stock, but based on how the macro is panning, how the earnings are coming through, you also fine tune your position. So, let's say I have 2% in a stock, but I see macro getting adverse, although I think it could be temporary, then I may go down to 1.5, right? So I think that's important, because sometimes if you don't adjust to this macro and that macro extends for a long period of time, you might be in a value trap for a extended period of time, and then obviously your long term performance will also get hit. So just to give you an example, I mean, when Fed started raising rates in 21, everyone said this 5% or 4% will not last for 1 year, 2 years. But there were 4 years since that 5% has lasted, right? The US 30-year yield is still at like decade high. It may not be all time high, I don't know. But obviously, if you asked anyone in 2021 that US 30-year yield being at 5, how long it will last, I can virtually guarantee you out of 100 people, at least 99 would have said this is a year or 2 year phenomenon and we'll go back to 0% ish kind of interest rate, right? Because the last decade's memory is there with everyone.
People are really used to it.
Yeah. Even actually 1 year back, when Fed started cutting rates, if you'd ask someone that the US 30-year yield will not fall an inch because of Fed cutting 75 bps, I think people would be surprised, right? So I'm saying you can't predict macro beyond a point. So it's better to react fast. Don't be too headstrong about it. Listen to the market and fine tune your portfolio so that if the macro continues in the direction it's going, you don't get caught out in a very, very bad way, because things tend to surprise.
So we are almost out of time. I'll just ask you last two quick questions. One is about you. So, I mean, it's easy to know your track record. Anybody can follow it in the fund management space. But you've also been an entrepreneur, right? So, VisiSoft, I hope I get the name right, is the company that you founded and ran for close to a decade. Can you just tell us quickly what happened to it? I see it's still functioning, but what happened?
No, it's a profitable company doing well. It hasn't scaled up as much as we wanted. So I started this with a couple of engineering close friends. We are all very passionate. I think if there's anything I like more than investing, it's technology. Technology entrepreneurship. So I also keep doing angel investing in deep tech companies. Keep losing money.
That's on the personal side.
Yeah, on the personal side.
Okay.
Keep losing money there as well. but yeah, I'm very both from a intellectual stimulation and also I think for society also, because I do think that the only thing that can carry India to the next level is technology entrepreneurship.
My final question is, so you've been the winner, right? I mean, the Bandhan Small Cap has been the winner. So for the past 3 years, how do you avoid the winner's curse going forward?
So you can't. First of all, we're not trying to time a performance for next 1 year. So next 1 year can be bad for us. I don't know. But as a process, we just think that we're not taking very concentrated bets on stocks or sectors. So hopefully, our investment process, which is, as I said earlier, it's been a bit surprising why we're doing so well. But our investment was more about being quartile two for 3-4 years in a row rather than being quartile one, because someone who's taking more macro risk or better concentrated portfolio should ideally beat us on a 1 year basis. So next 1 year, I don't know. But I do think that on a 3-5 year basis, ours a fairly resilient portfolio to my mind. Macro risk, valuation risk, I think I might be biased, obviously. I think we're not taking too much of either macro risk, valuation risk, and hopefully not too much of management risk. So yeah, I do think that we will deliver granular, predictable, and decent alpha.
I hope you do for the sake of investors. Thank you so much for your time. It
Thank you.
was really lovely chatting you for, and also thanks for all the candid responses.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.